Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to talk about 3 Canadian stocks that are at their 52 weeks low or close to their 52 weeks low. And I will discuss whether these stocks represent a good buying opportunity or not. Being close to 52 weeks low doesn't mean you should buy these stocks, but it means this is probably a good time to start looking at the fundamentals of each of these businesses and evaluate these companies. I want to go through the financials of some of these companies and share my perspective on these stocks with you. We have a lot to cover in this video, so let's jump right into this. The first stock, which is at its 52 weeks low, is Enbridge. Enbridge share price is around 49 Canadian dollar at the time of recording this video, and it basically trades at its 52 weeks low at the moment. The stock had a 52 weeks high of $59, so as you can see, this stock is down almost 17% in the past few months. Enbridge is a giant energy infrastructure and energy transportation company with massive footprint in Canada and US, which has 5 divisions: liquid pipelines, which is the most important source of cash flow for the company, gas transmission, gas distribution and storage, renewable power generation, and energy services. The stock is paying a huge dividend with a starting yield of 7.2%, and if you look at the history, they have 27 years history of paying and increasing their dividend every single year with a 10% average year-over-year increase in this dividend, which is an absolutely amazing track record, especially considering how many financial crises and stock market crashes we had in the past 27 years. And Enbridge basically were able to continue to pay out and grow these dividend payouts in all these financial situations. The company expects to be able to increase their distributable cash flow by 5 to 7% year over year, which is a modest expected growth, but it basically can support the dividend growth of the stock in the future. Interestingly, if you compare the recent performance of Enbridge in the last month to its peers in Canadian market like Pembina Pipelines or TC Energy, you will see that Enbridge dropped more than the other Canadian pipeline companies during this time. One of the main issues that hang over the Enbridge stock is their exposure to Line 5 and the uncertainty about what's going to happen about Enbridge Line 5 and all the fiasco that comes with that story. While I don't think these issues with Line 5 is anything new or will have any major impact on Enbridge, this company has a relatively high debt on their balance sheet, which is, in my opinion, the most important risk of their business. Of course, this is not weird as utility businesses usually utilize debt for growth, but still this is not a great balance sheet in my opinion. In terms of the valuations, Enbridge currently trades at 8 times of its cash flow, which historically is a good time to buy this stock as the average price to cash flow of Enbridge in the last 5 years is close to 10. One thing that I personally don't like about Enbridge is their low returns on invested capital, which is on average around 5%. For me personally, this is too low, and I only will be interested in a stock like that if the stock is significantly undervalued. But if you're looking for passive income, Enbridge can be a stock to look at right now. Overall, I personally don't own Enbridge at the moment, but I think Enbridge is definitely an interesting stock to consider if the share price drops a little bit more. The second stock which is close to its 52 weeks low is Bank of Montreal. Bank of Montreal, or BMO, has a share price around 115 Canadian dollar at the time of recording this video, while its 52 weeks low is just $111, which means it basically trades at its 52 weeks low at the moment. The stock had a 52 weeks high of $138, so as you can see, this stock is down almost 16% in the past few months, which is a lot. Actually, if you compare the recent performance of BMO in the last month to its peers in Canadian market, you will see that BMO and TD dropped significantly more than other Canadian banks like Bank of Nova Scotia or Royal Bank during this banking system fiasco in US and Europe. Of course, the reason for this overreaction is that BMO and TD they have more exposure to US banking system. However, I don't think these issues with US regional banks will have any major impact on BMO or TD. Historically, BMO stock barely drops more than 15%, and when it happened in the past, the stock always recovered in the next couple of months and hit a new all-time high in the future. In terms of the valuations, Bank of Montreal currently trades at 1.12 times of its book value, which is historically a good time to buy this stock. The only other time that the stock trades close to this valuation in the recent years was during the pandemic. The 5-year average price to book of BMO is 1.4, which means BMO trades at a discount at the moment. The stock is paying a nice dividend with a starting yield of around 5%, and if you look at the history, they consistently increase this dividend year after year. Overall, I think Bank of Montreal is definitely an interesting stock to consider here for your portfolios. The third and last stock which is close to its 52 weeks low is Aritzia. As you can see, 52 weeks high of Aritzia was 55 Canadian dollar, while it is currently trades close to $36, which means the shares of Aritzia are down almost 33% from its 52 weeks high, which is, in my opinion, represent a very attractive opportunity to look into this stock. Aritzia is an integrated fashion retailer, and it is the largest holding in our combined stock portfolio. I personally have 270 shares of Aritzia in my TFSA, and also my wife has 165 shares of this company. So we have over $15,000 invested in this company in our tax-free saving accounts. In my opinion, this is a fast-growing quality business with top-of-the-line business metrics in growth, profitability, brand quality, and value creation for shareholders. They increased their revenue by more than 100% in the last 3 years. That's more than 35% year-over-year top-line growth in their business. Similar to revenue, their bottom line adjusted diluted earnings per share also increased by more than 100% in the last 3 years. They reinvested their free cash flow into their own business and increased their number of physical stores consistently in the last several years. Their average return on equity and return on invested capital in the last 5 years were 24% and 14% respectively, which demonstrate the quality of their business and how profitable it is. In terms of the valuation, Aritzia currently trades for a price to sales of 1.9, which is significantly lower than its 5-year average. I talked about this stock a lot on this channel, so I don't want to repeat the previous information again. You can watch my recent video on Aritzia, in which I went deep into Aritzia business model, its valuation using discounted future earnings model, and also why this is a great stock to buy. If you don't own Aritzia, I think this is a good time to at least look into the fundamentals of the stock and do some research about it. There you are, guys. I hope you enjoyed the video and my coverage of 3 Canadian stocks at their 52 weeks low prices. If you enjoyed the video, make sure to subscribe to see similar videos. Remember that this video is not a financial advice for you to buy, hold, or sell these stocks. This is just my personal opinion, and you should always do your own research before making any financial decision. With that being said, I want to thank you guys again for watching, and I hope to see you guys in the next video. Farewell.